Joining me now is my first guest, Junbei Liu, Portfolio Manager at Tribeca Investment Partners. Junbei, thanks for your time today. Let's start with the performance of US stocks over the past year. It looks like it's been really tough for investors. What have been some of the major forces that have been pushing shares lower?
Look, absolutely. The US market is down significantly, far outweigh the Australian market, particularly the NASDAQ, which officially hit the bear market. The major drivers, including the higher interest rate expectations on the back of high inflation. High interest rate means those growth companies' valuation has become way too high. Hence why we see significant pullback. The tech sector across our market even has come off for somewhere between 40 and 50%. So very, very meaningful D-rate across those sectors.
Just how uncertain is the outlook at the moment for US investors? Is America falling into a recession?
Look, that certainly has been the fear, and it is well-founded. It's certainly most of the economists or most of the strategists are expecting US to hit recession perhaps in 2024. It's partly because inflation is rampant. They're hitting high single digits in the US. Food inflation somewhere between 9 and 10% in the US. Now, the wages has gone up a lot, but not enough to catch up with the inflation. Now, this is at the same time when interest rate going higher, consumer confidence is getting hit in the US. All of that together just means that they have to hit a pause in economic expansion, and if not managed properly, certainly will hit recession.
And those issues in the US, inflation, interest rates, it looks like we're starting to see their impact on Australian markets as well. What's the outlook looking like for you for Australian shares?
Look, Australian shares is much better position relative to the US. First of all, our inflation is nowhere near the inflation they're experiencing. It's probably half of the amount that we're experiencing at the moment. It's partly because our job market is slightly different. 2/3 of our job markets, the wage growth is linked to awards rather than the current market. But that will continue to put upward pressure, and everything else is doing a little bit better. Our economy, remember, quite a big part of it come from the mining, which has been a beneficiary of high inflation. The commodity prices has been very strong in the last 12 months. All that together just benefit our corporates as well as our economy. And don't forget, Australia has been in lockdown, bigger part of our country has been in lockdown for quite a while. So a lot of corporates are still recovering to their full earning potential post the COVID. So all of that together does mean our earnings is actually doing a bit better. At the same time, interest rate won't go up as much as what is expected in US, and inflation is not as bad. So that means the Australian market is looking pretty good, and our dividend yield is very high, all very supportive of a stronger market.
Yeah, you mentioned technology stocks being hit pretty hard over the last 12 months, and I think discretionary retail has had a tough time as well. What's the sort of outlook looking like for those two sectors?
Look, at those two sectors are actually quite interesting. Let's take retail. Retail sector will continue to experience significant pressure. When we talk to our economy doing well, now consumer is a sector is going to experience a bit more pressure simply because they have people have spent a lot of money on buying goods when they couldn't travel, and all of that will have to be tightened. So, just on a starting base, they have to come off. And secondly, high interest rate, high mortgage payments, as well as high cost of living just means the consumer will spend a little bit less compared to the previous years, while at the same time they will do that one overseas holiday that they all probably book in to do. So consumer sector is going to be tough. Travel will be okay. Now, technology sector is interesting. They're all slightly different. I would actually pay attention to some of the market leaders. Things like Xero. Share price has come off significantly, has moved from $150 to below $80, and its intrinsic value is incredibly strong. So this is a time really for investors to bottom pick some of those really high quality companies, because in an environment where economic outlook is not certain, investors very soon will come back to the structural leaders where they will continue to grow with or without recession. So we do expect that sector to do slightly better compared to the other sectors.
And just quickly, outlook for agriculture as well. Is that pretty rosy?
Look, for agriculture, it is pretty rosy on a medium-term view because we do expect continued upward pressure on agriculture, on food prices. Now, of course, the food prices has had a significant rally a few months ago as a result of the war in Ukraine. It has pushed up prices like wheat and palm oil and so many things. However, these prices has come off as a result of investor worry about recession risk around the globe. Now, we do expect that weakness to be short-term because as we look forward in the next 12 months, certainly some of those structural changes will remain to be in place and some of those shortages will continue to get only wider. So the food prices on a medium-term view is very strong.
Well, Junbei Liu from Tribeca Investment Partners, thanks for coming on the program today.
Thank you very much for your time.